Well, good afternoon. Welcome to our webinar titled What in the World is Going On? A Global Perspective on Financial Markets. I'm Nathan Mercereau, President of Planning Alternatives, and we are very excited that you've joined us today for this timely webinar. Many of you have been in tune with news headlines, looking at the financial markets, hearing the sound bites of what's going on in various parts of the world, and certainly there's been volatility over the past couple months that has really created concern for investors. And today we want to share this webinar as a way to educate, to inform, to engage you and create clarity and confidence around investing strategies. And we are just delighted to have our webinar guest, Jeffrey Kleintop, who is the Chief Global Strategist at Charles Schwab. And this is a real pleasure and a real treat for us. Jeff has been on the media throughout the past number of months, and actually yesterday was on CNBC Worldwide Exchange, Fox Business News, again on CNBC this morning. So you've been very busy, Jeff, and welcome, and please share maybe some of the things that you spend your time looking at in regards to your role at Charles Schwab.
Nathan, thanks so much for having me on, and I appreciate the opportunity to talk not only with you and your outstanding firm, but your clients, and I'm sort of excited to share some of my thoughts here. I have been in the media a lot lately. There's been a lot going on. You may know that Liz Ann Saunders covers the U.S. economy and markets for Schwab. My focus is kind of everything else, sort of everything outside the U.S., of course, as it affects the U.S., but as also maybe what's going on around the world affects everything everywhere, from commodities to currencies to of course the stock markets and bond markets. I'll be focusing my comments on some of these global issues that have really grabbed investors' attention lately and contributed to that volatility you referenced. So my team and I, we spend a lot of time looking at a lot of global economic data on the geopolitical angle to all of that, what's going on with central banks around the world, which is at an interesting point right now. And heck, we've even got elections coming up quite a few places around the world, including actually in Canada just next month, which could be material. Spain towards the end of this year in December. So a lot of interesting elections that could contribute some impact on the markets and the economies, much in the way the U.S. election may come next November. So a lot to keep an eye on and a lot of thoughts to share.
Great. Well, we appreciate all the work you do. I've seen you in the media a number of times, heard you speak. It's a real pleasure to have you with us today. I want to remind our attendees that we'll have the PowerPoint that you can view on your screen. And you can submit questions along the way. And one of the things that is unique about our webinar series is that not only do we cover timely topics, but we use this as an avenue for you to get questions asked to our distinguished speakers. So if you look on the toolbar on your computer screen, you'll see a place where you can submit questions, and our agenda today is to take probably 25-30 minutes of discussion around some various topics, as Jeff alluded to, and then wrap up the webinar specifically answering your questions, and we look forward to hearing from you. So Jeff, as we get ready to think about our conversation, you're an expert on global financial markets, and we hear the word growth a lot, and obviously we know growth is a positive word, but could you just spend a little time explaining why growth matters and what happens if we've got too much growth, or what happens if we have no growth? Just kind of set the stage of why this growth item is really important.
Sure, it's a big picture question. Growth, essentially, whether it's in an economy or however you want to classify it, comes back for all of us, I think, to earnings growth for corporations. That's ultimately what makes those bond payments for companies, and what drives their stock prices higher. At the end of the day, if you don't have earnings growth, you're not likely to see stock prices move higher. Earnings are truly, as my friend Larry Kelso likes to say, the mother's milk of the stock market. So it's very important to see that continue to grow. It's very rare to see earnings grow in an environment where there's no economic growth. Economic growth is often the driver of sales for companies. Earnings can magnify, the growth in earnings can be magnified relative to that growth pace in sales given changes in margins or pricing or a number of different factors. So often we see earnings grow a bit faster than the overall economy, especially for some of our best and biggest companies. But overall, growth is essential to ensure that we get our bond payments and to ensure that earnings are headed higher and pushing stock prices up.
So when there is no growth or low growth, what does that lead to? What are the implications? What's the ripple effect of that scenario?
Well, we become very vulnerable to a pullback in prices to then align with those underlying expectations. So if growth is just flat, then that would sort of imply maybe the market environment overall being flat, unless the market was expecting much higher growth. So the market's all about expectations. And so if it's expecting growth and then doesn't get it, even in a flat environment for earnings, such as where we are now, that can contribute to a lot of volatility in the market. If earnings are falling very sharply, then stock prices need to align with that reality, and they usually pull back. The last two major declines in earnings that we saw were, of course, in 2008, 2009, and in 2001 and 2002. Both coincided with very dramatic downturns for the overall stock market.
There's a number of firms out there and some pundits that are saying we are on the cusp of a global recession, that things are going to slow down dramatically, and we really need to keep our eyes open because these are precarious times. What's your take given that perspective?
Well, I take a very fact-based approach to the world. I mean, here at Schwab, like you, Nathan, we don't have a dog in fight. We don't have an axe to grind. We're not an investment banking firm that always wants things to go up so we can sell more stocks or go down because we're a hedge fund that specializes in shorting. We're just going to tell it like it is. And the truth is, broadly speaking, economic growth is pretty stable. In fact, it's likely to even pick up next year. Let me just show you a chart. If we want to just go to the next chart here, this is one of my favorite indicators to watch. It's very simple. You can Google it to actually get it up on your screen if you want to watch it on a real-time basis. This is the Citigroup Economic Surprise Index for the G10 countries. These are the big countries that make up more than half of the world's economy. They include the U.S. and the U.K., lots of Europe, Japan's in there. And what we see here is this little line. It doesn't look like it's done a whole lot this year. It's gone down a little. It's gone up a little. What this measures is how economic data is coming in relative to expectations. So if data is weaker than economists expected it would be, the line will be falling. And if data every day, this is updated every day, if it comes in better than expected, the line will be rising. And in general, what we've seen over the last few months, now I haven't updated this for the last few weeks, and it's slumped back down to that zero line, but it's been rising. It has not been rapidly or broadly deteriorating across the globe. It's actually been hanging in there, suggesting stable, solid global economic growth. And this is really important because, again, it's updated every day, and it reflects all of the data points out. It doesn't just cherry pick one or two. This is all the economic data we get every single day, and you can get a good sense of whether this is improving or deteriorating. And, Nathan, the really interesting thing about this is that it tends to follow this pattern every year. It kind of falls in the first half of the year and rises in the second half. You can see that on this next slide, that over the last 5 years, we often get weaker than expected economic data in the first half of the year, even well into the summer. And it causes many economists to go, uh-oh, things are falling apart. Economic data is consistently coming below my expectations, and that must mean things are really deteriorating. But usually what happens is things firm up through the summer and improve in the second half. This has to do with weather. It has to do with budgets. Budgets are often more austere in the early part of the year. We see a sequester kick in or austerity in Europe. Central bank stimulus policies sometimes have expired at the end of one year. So the beginning of the next year, they were a little weaker until they were renewed. There's a number of macroeconomic and other weather-related reasons why we see this pattern unfold, and it's again unfolding this year. So I don't see this deterioration we saw through the first half of the year continuing. I think it's stabilizing, and in fact, I think next year we might even see stronger global growth than we're seeing this year. The IMF, the World Bank, and we as well as many economists out there expect about 0.5% better global economic growth next year than we're seeing this year.
You know, that's refreshing to hear, because when we turn on the media or go to the internet and see all the headlines about what's been going on, my gosh, you'd think the world is getting ready to end. And certainly Greece has dominated the headlines, and we'll get to what's going on in Europe a little bit later in our discussion. But what do you see as driving some of this growth that you're alluding to?
You know, it's a great question, because so much of the data we get, this economic data that the Citigroup Economic Surprise Index measures, is based on manufacturing and commodities. In fact, I was just looking the other day at my team working on this, and what we found was that about 80% of the data let me put it a different way, only about 20% of the data that we get in a given month, lots of data on the global economy, only about 20% of it is on services. The rest of it is on manufacturing, or kind of a mix of manufacturing and other things. And manufacturing is globally, well, it's been weakening. And so we've got this constant drumbeat of data and headlines showing things have slowed down. For example, the manufacturing sector in China, or in countries like Russia or Brazil, very focused on commodities and manufacturing production. But let me show you on this next slide how that kind of shakes out. I call it serving up growth, because the most important driver of global economic growth is what we call the service sector. Nathan, it's what you and I do, right? Financial services. There's healthcare services in this country. Services dominate our U.S. economy. They make up 80% of our economy. They do that in Europe, and they do that in Japan as well. Manufacturing and construction and commodities are much smaller, only about 20% of the global economy. And so it's very important to pay attention to service economic data versus manufacturing data, because service accounts for 4/5 of global economic growth. And what you see in this chart here is the Purchasing Managers Index, one of my favorite indicators of economic growth. And you can see it both for services and for manufacturing. Manufacturing's been sluggishly kind of slowing down for about 1.5 years now. It's been slowing down even more at a more quick pace in China and a few other emerging market countries. But what you can see here is that overall the pace of services, again, 4/5 of the global economy, is actually holding up pretty well. In fact, we just got the data this morning for both the services and manufacturing sector in Europe. And again, the services component, again, 80% of the economy, was strong at 54, nearly at a 4-year high. So this is a pretty important thing to keep in mind, that the data we constantly hear about measures something that, yes, globally is quite weak, but we've not seen a recession where the service sector wasn't rolling over and deteriorating at the same time as the manufacturing sector. And that's simply not the case right now. 80% of the world economy, even in China, 80% of the world economy, the service sector, is in pretty good shape, and even growing at a fairly robust pace.
No, that's great insight. Now, the next question is about what's going on with yields and treasuries, and the U.S. is at an all-time low of interest rates and having an environment that was enacted a number of years ago to help navigate the financial crisis. Actually, on a side note, we got feedback. There's some noise on your end, Jeff. If you're on speakerphone, maybe you could pick up the phone, and that might give us a little bit clearer connection. Sorry about that. But back to the interest rate environment, what's your sense of the U.S. in terms of the U.S.'s economic position?
Sure. Well, one of my favorite indicators for a recession, whether it's in the U.S. or globally, is the yield curve, is these yields that you're referring to. It's kind of, you've got this chart up here. For me, this is an incredibly important thing to pay attention to, and it's very simple to do. It's a complicated chart, so let me just take a second to explain it. The purple line that kind of zigzags through the middle of this chart is what we call the yield curve or the yield spread. It's simply the difference between long-term and short-term interest rates. And so usually there's a difference of 2%, or you can see on the left-hand side, 200 basis points between the two. But sometimes there isn't. Sometimes the Fed raises short-term interest rates, and what we find is that that purple line goes down. The difference between short-term and long-term interest rates is wiped out. Sometimes it even inverts, we call it, where short-term rates get above long-term rates, and that's right. That's when we're below zero. And what you can see on this chart is that that point at which it gets below zero, I've marked it with that orange, with those orange dots, comes ahead of those shaded gray columns, which we all know are recessions. That's generally how we chart recessions in among economists. What you can see here is ahead of every single recession in the U.S. over the last 50 years, the yield curve has inverted. Short-term rates went above long-term rates. Usually about a year before the recession started, somewhere between 8 and 14 months before that recession, the yield curve inverts. It's a perfect leading indicator. Has been in the past. I don't know. Listen, I spent a lot of time on TV. I don't know any other economists or strategists that have been right 7 out of 7 times over the last 50 years in calling every recession a year before it happened, never making a false positive indicator. It's an incredibly valuable forecaster, and also importantly, that blue line up there, which is the S&P 500, what it shows is every one of these yield curve inversions lined up just about with the peak of the stock market, just before the stock market began to roll over, almost within a month or two of the peak. So it's a great indicator to tell you a recession's coming. It's also a great indicator to tell you, the stock market, might be on the cusp of a little bit of a pullback, a bear market perhaps. And what it's telling us right now, which is why I bring it up, is that we're nowhere near that. We're actually near the long-term average between short and long-term interest rates. Now, we know the Fed's going to begin to raise short-term interest rates. Over the next year, we think they might raise interest rates by 1%. It might take them 2 years to even get to 2%, and I think along with that, the longer-term interest rates may rise a little bit. It could be 2-3 years before we see this purple line get down close to zero. So that would suggest that we're still pretty far away from a recession here in the U.S. based on the most reliable indicator over the last 50 years. And I just point, we can do this for other economies as well. The next slide just shows the exact same thing for Germany. I could do it for the Eurozone. I could do it for Australia, for Canada, you name it. This is a great indicator whether the globe is on the cusp of a recession. Here you can see in Germany, that purple line's a little closer to zero, but it's not quite there, and it's actually been rebounding here lately. A good sign that maybe Europe has averted a recession here in the last year or two. So overall, I think the bulk of the data points to continued global economic growth next year, perhaps even accelerating growth.
Well, that's good news. On the banking side, there's a lot going on with not only the U.S. Addressing interest rate policy, but policy in other central banks around the world. The Fed last week did not raise interest rates. Do you think that was because of some of the recent concerns, or did they get spooked with some of the headlines as of late, or not?
It seems that way. We had sort of this, we've got a few things going on. One, commodity prices took another trip down, so the pressure on inflation just isn't there for the Fed. Another factor in the background, noted or not, we're likely, we got a 50-50 shot at seeing another government shutdown at the end of this month. So, that's there. I'd point out that was also the case back in September of 2013 when Ben Bernanke, then head of the Fed, decided not to taper the quantitative QE program, the Fed's bond buying program, in September. It was previously announced he would. Instead, he waited till December to do that, got around that government shutdown that took place at the end of September. So I think that was a factor in the background, but also this concern that was cited by Fed Chair Janet Yellen that this deterioration in manufacturing conditions, particularly in China, bears a little bit of watching. She more referred to volatility in the markets than anything she actually saw taking place. She noted that, their view hasn't changed on the global economy, just figured the risk of waiting another month or two was not that high. But I think that, if you flip to the next slide here, the Fed is likely by the end of this year, perhaps in December, as they did back in 2013, may begin to hike interest rates, as then they began to taper their quantitative easing program. But the Fed won't be alone. So what this map kind of shows you here, the blue ones are the ones that have started to raise interest rates already here in 2015. It's Brazil, it's Venezuela, Argentina, Ukraine, South Africa, Iceland, and a few others are likely to join the U.S. very shortly. We'll likely see the U.K. begin to hike rates early next year as well. So what we're seeing is kind of this global shift in monetary policy, and not just one country out of the world moving in that direction. Broadly speaking, we're likely to see that. And so I think next year, you see on the next slide, we're likely to see, you're going to see the U.S. and the U.K., Mexico, probably South Africa and Turkey, which don't want to have to hike rates, but they may have to. It's not a good thing for their economies, but their currencies are plunging and they need to do that. They'll be hiking rates. On the other hand, there are some countries that have been cutting rates in 2015, likely to go on hold, like India and Russia, Switzerland, a few others. And then there's some countries that are absolutely going to continue with that pedal to the metal, providing stimulus to their economies, most notably China, the Eurozone, and Japan. Finally, go ahead.
Oh, one of the things that is, I'm sure, confusing for many of our clients is to try to understand what happens between a headline and the actual stock market activity. And many times there's a big gap or disparity in time or in impact between what we hear about around policy and then what actually happens in the financial markets. So maybe this slide here, maybe we'll point a little bit toward that.
Sure. This is a fun one, an interesting one, I think. And we often get associated with this idea, Nathan, that when the Fed cuts rates, that's a good thing, and the market likes it. And when they hike rates, that's bad, and the market's going to sell off. History shows the actual opposite to be the case, because usually when the Fed or another central bank is hiking rates, as every one of these you can see on the top of this chart have done since the global recession. So in 2009 or 2010 or 2011, Norway and Israel and Europe and Australia, they all hiked rates at one point, coming off of their kind of emergency cutting rates to zero environment. And when they did, the markets welcomed it because it was a sign the economy was getting better, was able to withstand higher interest rates, more competition for capital. But what happened was that they were all moved a little bit too quickly. And on average, they raised rates 2 or 3% in less than 1 year. And every one of them, because of that very rapid pace of rate hikes, had to turn around and cut again. And the market didn't like that. And so you can see in every case those markets fell. So the Fed has learned from this, and that's why I think they're going to go very slow. And it might take 2 or 3 years for them to raise rates by 2 or 3%, as opposed to do it in 9 months, as many of these countries did, wanting to avoid that risk of having to pull back and cut rates again, which certainly I don't think the market would welcome.
Interesting. Now, I know that one country has dominated the recent headlines, and that is China. And there's been a lot of questions about what's going on within the economy. Is the data that's being shared accurate? What's your take on China? How do we navigate and have a sense of understanding of what's going on there, and how would that impact us in the U.S.?
Nathan, it's really hard because a lot of the Chinese economic data is, published by the Chinese government, and it's the quality of it is not. Let me just give you an example. So China usually comes out with their GDP number within about a week and a half of the end of the quarter, whereas in the U.S., it usually takes 2.5 months for us to come up with what was GDP in the prior quarter, right? Because there's a lot of detail and transparency into what the Bureau of Economic Analysis in the U.S. Does and delivers to the markets and economists. In China, there's none of that transparency. They come up with a number, God knows where they get it, and they just say, There's the number. There's not a whole lot of detail to it. So we take a lot of things that the Chinese government says about their economy with a bit of a grain of salt. We want to verify it with other independent private sector measures of data, export data, port traffic data, taking a look at electricity usage, taking a look at what companies inside of China are saying about demand, those types of things to corroborate what's being reported at the governmental level. But one thing that's interesting is that we think of China as this big manufacturer. Right? I mean, Nathan, look around your office right now. Probably everything in there was made in China, right? I mean, everything. They make everything, sure. But what's fascinating is that China, even in the last few years, has become much like a Western-style economy. They have grown their service element of what they do as a percent of their GDP way in advance of manufacturing. The blue line on this chart just shows what percent of China's GDP is tied to manufacturing. And even just 4 years ago, manufacturing was most of what China did. But now, it's been reduced greatly, and and services, as I've mentioned for the global economy, is now a much more important element. I think as we get some of the data here towards the end of this year, we'll see maybe a 10 percentage point gap between service and manufacturing in China. And that's important because you can see on the next slide, China's services are actually growing, doing well, while their manufacturing sector, along with the rest of the globe, has been slumping here over the last year. So while we're concerned that China's manufacturing has slowed down, Chinese policymakers are concerned at the pace of it. It was intentional. I mean, China does want to slow down the manufacturing portion of its economy. It doesn't want to be dependent on manufacturing anymore. It wants to build more of a service-oriented economy. They've been successful at doing that, and that growth has been maintained, but a lot of focus is still on that manufacturing output, and a lot of concern about China hitting a wall and falling deeply into recession, I think misses the point that now the bulk of China's economy is actually growing and supported by very strong consumer spending, which is running at 10 or 11%, along with incomes in China. So that's real solid support for that economy, which is the second largest in the world. And the next slide, I think is sort of a fun one. And it's important to keep in mind, so many of the times, Nathan, I wish you were on CNBC interviewing me, because half the time I get asked these ridiculous questions about, hey, isn't, with China's stock market falling apart, isn't clearly its economy falling deeply into recession? This is just a dot plot. And it's essentially every single year, last 20 years, you see on this chart. And what you're looking at is China's GDP across the horizontal axis, and the vertical axis is China's stock market. So you can see the relationship between gains or losses in the stock market and growth or contraction in the economy. As we mentioned at the start of this call, Nathan, when you asked me that set-up question about, why do we care about growth? Because usually growth in an economy means growth in earnings. It means growth in the stock market. Stocks are usually a good leading indicator for the economy. Not in China. What we can see here is there's no relationship between China's stock market and its economy. In fact, we can measure this statistically through a measure called correlation. It's 0.00. You literally can't get any less correlated than the Chinese stock market and its economy. And there's many reasons for that, but let me give you two quick ones. One is that companies do not raise money in China in the stock market. It's a young stock market. It's not a primary source of capital for any businesses. And two, households, you and I, if we were Chinese, aren't big investors in the stock market. The Chinese tend to invest in a number of different things, property and gold and quite a few things. They do not really invest in the stock market. Only about 6% of household wealth is in the stock market versus the U.S., where you've got nearly half of it, right? So in the U.S., if the stock market pulls back, hey, we might pull back. We might not buy a new car this year. We might pull back on our spending in other ways. Not true in China, because it just doesn't affect the broad populace of consumers. And that's why there's really been no relationship with the Chinese stock market, which is in a bear market right now, and its economy, which seems to still be producing a pretty strong, around 7% pace of growth.
That's great perspective. Now, another country or part of the world that has received a lot of attention is Europe, and Greece has been at the forefront of the headlines, but there's been plenty of moving parts with the European Union. What's your perspective on the European markets?
Europe, I think, it's emerged from, was in recession in 2012 and 2013. Things seem to be firming up in Europe, and this very aggressive policy the European Central Bank has put in place of not only zero interest rates, but doing a lot of quantitative easing, doing a lot of bond buying. We know that tends to lift stock markets. It seems to be now lifting lending growth within Europe. Consumer spending has picked up, really benefiting from the falling energy prices. So Europe seems to be the place where global growth momentum seems the strongest, and so that's encouraging. It's one of the sort of bright spots around the world. And in fact, if you look at the Europe stock market on this next slide here, it's very heavily driven by financials. And this is just something I like to do. It's a little complicated, but I'll just take a second to explain it. What I like to do is look at what drives a region or a country stock market. And what you see here is just if you took the world financials, you took the world sectors and you broke it down and you see what describes the behavior of European stocks the best, it's about a 43% weight in financials. So they're very important to what drives the European economy. And given what the European Central Bank is doing, pumping cheap money into the banks and encouraging to make loans and propping up their assets through asset purchases. I mean, it's just like free money for the banks. So they're doing great, and that's really helping to lift their overall stock market this year, and helping to support their stock market this year. And it's a good sign on the back of solid economic growth. And the next slide, I just point on the valuation side. The concerns about global economic growth and a return to recession have hit Europe because Europe was just in recession a couple of years ago, and so valuations, the price to earnings ratio for stocks in Europe are cheaper than those in the U.S. That's the line here. Just shows those valuations versus the U.S. and they're not only well below those in the U.S., but they're even about one standard deviation below their average to those in the U.S. So looking relatively cheap, along with some positive growth prospects. We like Europe. We think European stocks may outperform those of the U.S. modestly over the course of the next year.
Another country that we've talked about in the past, but has kind of been on the back burner from a conversation perspective, is Japan. And Japan has had a lot of ups and downs, prolonged recessions and stagnation within their economy, demographic challenges, etc. What's going on in Japan? It's actually reappearing on the conversation radar.
Yeah, I mean, Japan's economy is very outwardly focused. So we often talk about the demographic challenges or political ones or debt ones. But the reality is that Japan is just very, very focused on what's going on in the rest of the world. Japan's a huge exporter to the rest of the world, and very dependent on, you can see on the next slide, similar chart to what we did for Europe, very focused on technology and financials. They really dominate what goes on in Japan. I'm a big believer that sectors matter a lot when it comes to looking at countries, especially countries like Japan, which are very driven by global factors. So I think we often spend too much time worrying about what's going on within a country, and a lot less on how well that country's positioned to go to focus on what's going on in the rest of the world. And because of their focus on technology and financials, our two favorite sectors, the economy is lined up very well to benefit from growth in those areas. The next slide just shows valuations look like they do for Europe. They're cheap, and so that's a couple of the reasons why Japan has been the best performing major stock market so far this year. And I think this next chart really brings home the ultimate reason why, and that's because the amount of stimulus being provided in Japan is truly Godzilla size. Let me explain what I mean by that. The first time Japan did a quantitative easing program, remember these programs of asset purchases done by the Fed and the European Central Bank and others, well, it took place quite a while ago, and when it did, Japan's monetary base was 50 trillion yen, and at that time, Godzilla, in the very first Godzilla movie, was about 50 meters tall. But you can see around the time of the next QE program, the monetary base, literally how much money is floating around Japan, had doubled to about 112 trillion yen. Likewise, Godzilla in the 1984 movie was about 100 meters tall. Let's jump forward to last year's summer blockbuster, Godzilla. The monetary base up to 222 trillion yen with the continuing QE program, and Godzilla, sure enough, over 200 meters tall in that giant blockbuster movie last summer. I think if we've got another Godzilla movie coming out next summer, it's going to be too big to get on the screen because that program not only continues and is now well over 300 trillion yen, they're actually likely to increase that in October, meaning increasing the monthly pace at which they're literally printing yen. That we know doesn't necessarily have a huge impact on boosting an economy, but we do know it tends to boost markets, both fixed income and equity markets, and that's one of the big drivers we're seeing in Japan, not present here in the U.S. So we've got Japan focused on the right sectors, technology and financials. The stocks are relatively cheap versus the U.S., and we're also seeing this incredibly powerful central bank program that may not work long-term to fix Japan's economic problems or demographic problems, but in the near term is likely to continue to lift their markets.
Oh, this is a great chart. A picture says 1,000 words, and this is excellent. I want to remind our listeners to submit questions, and if anything has piqued your interest as you've listened to Jeff and you'd like to ask a question, please do so. And we've got about 5 or 10 minutes left in our webinar, and certainly appreciate any input that you have, and our questions will show up and we'll address them. Now, on an international investing perspective, Jeff, there's been a lot of volatility in the financial markets, and our job is to help our clients gain perspective, keep a view in the long term, and navigate all the change that goes along with their financial journey toward their financial goals. But international investing really represents a unique component of a diversified portfolio, and maybe you could speak to some perspective on the benefit of thinking about investing on a global basis.
It's really important right now. You know, I think a lot of the questions I get as I travel around the U.S. are, hey, you know, isn't a lot of this concern coming from outside, concern about global growth coming from outside the U.S., so shouldn't we just be focused on staying close to home, you know, not having any international exposure in your portfolio? And I couldn't be more you know, vehement in saying no, it's the wrong answer. You actually want a good portion of international exposure in your portfolio, particularly right now. This slide just nails it. You know, over the peak of the pullback from August 17th to August 25th this year, the S&P 500 had what we call a correction, a fall of more than 10%, fell 11%. But during that same period of time, international stocks, including those that have emerging markets in them, only fell 7%. And that wasn't just a unique moment in time. Actually, if you look year to date through that low point, so the low this year, stocks have bounced back a little bit since August 25th over the last month, but they were down 9% year to date. And international stocks had done much better than that. So global exposure and a global perspective in your portfolio, even in a year where a lot of the concerns are coming from China or Greece or where have you, still benefited your portfolio in buffering the downside. And that's the true value of international exposure, because you get a lot of global sales exposure from companies like Nike, from companies like Apple, from companies like General Electric, from companies like you know, Microsoft. You get a lot of international exposure, but you don't get the full diversification benefits of really having a lot of wider array, a wider opportunity set of companies. And I can show you what I mean by that on the next slide. I was watching them. Did you see the Masters this year?
Yes, I really enjoyed that golf tournament.
You know, it was interesting. So the U.S. Open was a mess, and the grass was terrible and everything. But interesting, the same thing with the U.S. Open and the Masters. I was watching it, and after a while, I was just noticing every time a golfer came up, they put a little flag of where the golfer was from up on the screen. And I was like, oh, it's the Masters. It's in the U.S., and the U.S. Open was in the U.S. as well. I was surprised to see so many foreign flags. So I went to themasters.com, and I downloaded all the golfers' names and all the countries they were from, and put it in Excel, and I went, wow. You know, I was amazed to see that the distribution of players at this year's Masters tournament is exactly the same as those in the MSCI All Country World, as the stocks in the All Country World Index. Literally, the players at the Masters reflect the opportunity set for investors around the world. About half of them from the U.S., about 16% from Europe, 13 to 14% from the emerging markets. Just amazing to see such a similar globalization taking place, whether it's in a sporting event like the Masters or around the world. We often think, well, that makes sense. We want the world world's best players competing on the world stage there at the Masters. And so we want to exclude foreign players. We want to see that mix. But somehow when it comes to our portfolios, we think, whoa, that seems like too much international exposure. I'm sure you probably, heard the questions from time to time, Nathan, right, about, hey, why do we have that international exposure? Hey, it seems a little too high, right?
Yeah, always when it's going down, it seems a little too high.
Exactly.
It's
We
human
tend to have
nature.
kind of a human nature. We have this home country bias, particularly to view anything that's unfamiliar as risky. And so when it's going down, we tend to get worried about it. The next slide I think is interesting. Well, we could just take this to an extreme and say, well, fine, you want to stay in the U.S. Or you could just invest in your state. In fact, there are a lot of companies headquartered in various states. This is from the Philadelphia Federal Reserve. This is their May 2015 kind of GDP reading by state, because we don't have just one economy in this country. We have 50 of them. And you can see back in May, 8 of those states, of those little economies, were in recession, and 8 of them were actually booming. That's those darker green growth states. And it's interesting, you can kind of see a common denominator there with energy, given Alaska and North Dakota and Oklahoma and Louisiana, all very tied to energy. That's where we saw a lot of the weakness across the U.S. So different economies and different performance as well. Stocks in the state of Texas underperform those stocks headquartered in New York by 60 percentage points over the last 3 years. So why don't we invest based on, state economy or state performance? And the reason is, of course, we're talking about companies that are national and multinational in their businesses. And so the reason why Texas companies underperform those in New York is Texas. A lot more energy companies in it, and New York has a lot of financial companies, and energy underperform financials by about 60 percentage points. So it really comes down to the sector that drove both the economy and the markets here, rather than the overall uniqueness of the local environment. And we can see that globally here in Japan. Consumer staple stocks in Japan, like Japan Tobacco, for example, have tracked for the last 5 years other world consumer staple stocks like Coca-Cola or Nestle or you name it, rather than other Japanese stocks, which is that orange line across the bottom. Because if you're a financial or a tech stock or a consumer staple stock, you're much more likely to behave like all those others around the world selling to a global marketplace, rather than just those other stocks within your country. And it's also true, you can see on the next slide, with regard to Canada. You can see that orange line across the bottom. That's the U.S. stock market over the last 15 years. Looks like it's done almost nothing, but that's because I had to stretch the scale out so much to get Canada on there, which has performed really just like the U.S. energy sector. Canada is like one giant energy stock, a very natural resource dependent economy. So I like to think that really matter a lot more than countries or states for that matter. And that's why when we approach investing, I think it's very important to have a kind of a global mindset. The next slide, I think, really brings home the value of that, which is it's not on the performance side. On the upside, whether you're talking about international stocks or U.S. stocks or a blend of the two in that world, they've all done about 10% over long-term 10-year periods of time over the last 50 years or so. So you don't get better performance in the U.S. or international all the time. They're about the same because from a sector standpoint, they're all selling to the same global marketplace. That makes sense. The difference is on the downside, and that gets back to that first slide I'd shown at the beginning of this section, that it's really about the downside where international exposure helps you. Here, over the worst period of time over the last 10 years, which is the period from February 99 to February of 09, we saw stocks in the U.S. fall about 40%, or about a 4% annualized negative return. But internationally, stocks only fell 1% annualized, or about a 10% negative return over that period of time, much less downside. And the reason is a much broader opportunity set of companies than just focusing on those in the U.S. So it's not the upside so much as it is the downside. It's when we get worried about the global economy and volatility begins to pick up, as it has lately, that international exposure really tends to show its benefit.
Well, we continually communicate to our clients that diversification is a key part of their investing strategy, and it's the intersection of two perspectives where you're never going to make a killing, but you're never going to get killed. And that's why having a globally diversified portfolio really makes an impact within an investing strategy. One question came in regarding the Japan Godzilla money printing, and what's that doing to inflation? Is that doing anything to really kick in inflation with all this fiscal stimulus that's happening there?
You know, that's the intention, but so far, inflation in Japan has remained fairly flat, around zero. I don't know what it would be if they hadn't done this program. It would likely be, quite a bit negative. But on a year-over-year basis, it's only 0.2% in Japan. We've got global commodity prices falling. That's certainly been a lot of external factors helping to push down inflation there. If you strip out energy and food, it's still not doing much, only up about 0.5%. Ultimately, over the long term, that is likely to generate a bit more inflation for Japan, but they were expecting to get to 2% inflation here over the next year or so. That doesn't appear likely now. It's one of the reasons why they're likely to even step up that program of even more printing of yen to try and overcome these global deflationary forces.
Well, Jeff, this has been an amazing commentary on what's going on in the global markets. Your expertise has been greatly appreciated. We've certainly are privileged to have you on the webinar today. We've gotten a lot of great feedback about how people have enjoyed you, seen you on television, reading some of your commentary. So just want to thank you for your time. And we also want to thank our attendees for joining us today. Had a great turnout. You will be receiving a follow-up survey about an hour after our webinar here, and we'd love to hear your comments, what you liked, what made an impact on you, and also some ideas for future topics about our webinar series. So thank you, Jeff, for attending, and really appreciate your time.
My pleasure. Thanks so much. Had a great time. Thanks, everyone.
Thanks.